Good afternoon and welcome to AmeriCatalyst 2011 series of great debates in housing finance. Thank you all for being with us this afternoon. For the past 9 years, AmeriCatalyst and its sister company, EuroCatalyst, has produced a very unique and exclusive annual think tank focused on the impact of globalization on the housing finance industry. The irreversible forces of globalization will only continue to magnify and accelerate everything significant, including and perhaps especially the excesses and inefficiencies of our industry. In short, globalization means never having to say unprecedented or unintended consequences again. It's understood. This series of webinars, which we will present to you each quarter, coincide with the 10-year anniversary of our annual conference, which is being held in Austin, Texas, this November 6th through the 8th. I hope you'll all be able to join us, as it will certainly top anything we've ever done before. I'd like to sincerely thank Field Asset Services, who actually approached us with the idea to produce this series, as well as CoreLogic, for underwriting the cost of this webinar in order for you all to participate at no charge. Since our U.S. launch in 2009, FAS and CoreLogic have been our largest supporters, allowing us to continue the differentiation of our event, basing it on its purpose and not its profit. I'm going to go over some very quick housekeeping here. You can listen to the discussion from your telephone, but please turn off the volume on your computers to avoid a slight delay, which Christian mentioned, I believe. Second, given the prolific nature of our panel, we will inevitably go over our time limit, so please know in advance that we're likely to run for an hour and 15 minutes. Also, by this Friday, we'll send you an email to all of you, which contains links to listen to the webinar once again if you're unable to stay for its entirety. You'll also be able to download today's presentation and recommended reading materials. We'll test you on them in November. Today's weblog is diving into the wreck, calculating the costs of foreclosure. The metaphors we use are very, very deliberate, and our titles are very loaded because we want you to think about them and then think about them again. Those of you who know us well know that we always begin our sessions with a musical introduction and editorial, and today is no different. So I'll start the song, and you can jump in at any time. We'll start with What Do You Do with a Drunken Sailor? Just kidding, seriously. I chose the topic of foreclosures for this first event because of notable discrepancies in reporting, analyzing, and calculating these numbers. Given the profound importance of what these numbers actually mean in all aspects of socio-political and economic structure, I wanted to cut through the informational chaos by holding a discussion with the best analysts in the industry to understand why those discrepancies exist, what the real numbers are, and most importantly, their implications. I'm honored to introduce you to the best analysts. Each of them come from a different angle. However, what I find the most unique about each of them is their ability to contextualize the big picture and what it means in simple terms. So with us today are Laurie Goodman, who's the Senior Managing Director at Amherst Securities and typically comes from the investor's perspective, Paul Miller, Managing Director of FBR Capital Markets with the approach of the financial institution and bank analysis, and Mark Fleming, the Chief Economist at CoreLogic, who sits on top of the most valuable information in the industry and reports to God. Our discussion today is organized into 3 main sections. First, we'll discuss sizing the cost of foreclosure, which encompasses short sales, the shadow REO inventory, negative equity and delinquency, geographic concentration, and other issues involved in deriving accurate numbers on foreclosures past, present, and future. From sizing, we'll move on to calculating the cost of foreclosure, in which we look at the impact on investor loss severities, servicers, banks, house prices, and the overall economy. And finally, we discuss proposed solutions and their prospects in the context of paying the cost of foreclosure. In particular, which groups should bear the astounding costs of accumulating losses and/or loss mitigation and intervention. In other words, social policy. With that, I'll turn this over to Mark Fleming. Mark?
Thank you, Toni, for the introduction. So we're going to start out basically with some very obvious slides around the concept of how much is out there, and most particularly, and in keeping with the releases that came out today, the distressed sales share. We'll start with that. We all know that there's not a lot of housing sales going on in the market today. I think the release this morning was new home sales are at their all-time low since 1963. That's not to be expected, but more importantly, the type of sales that are occurring are also very different than usual. So if you think of REO and short sales as sort of the exit strategies from that foreclosure stock that Toni was mentioning, we're looking at about in 2010 there were 1 million distressed sales. We include REO and short sales in that definition. As a share of the market, we are slightly off the peak of nationally at 33% of all sales back in late 08, early 09 being distressed, but we're sort of running a rate of about 25% right now. This, of course, varies dramatically from state to state. For example, in California, the distressed sales share is just over 50% of all sales that are there. Also, when you look at this, you'll notice that while short sales have increased dramatically from basically barely nothing in the earlier time periods of parts of the decade, they're still running at only about 8% of total sales and not close to even half of the distressed sales share. So I think short sales, while they are occurring, they're still a disproportionately small amount of the sales activity out there, and that's important to note because a short sale is usually done prior to the foreclosure event, and so this is really a way to mitigate the foreclosure problem prior to it happening, whereas an REO sale is really symptomatic of the flow of things in through the foreclosure process. Next slide, please. As I mentioned, demand is very, very low, and the numbers of this morning indicate that that trend is continuing, and it's also playing through into prices, which we'll talk about a little bit later. But our expectation is that there won't be much more than 3 million new and existing sales in 2011, which is significantly lower than the peak. The red line here is showing the annualized month-over-month rate. You can see the high degree of seasonality, and that's certainly playing a role at the moment in the numbers that we see. We're in, the January-February timeframe is obviously the slowest period of the year in terms of seasonality, and so we do expect declines in house prices, in sales activity. But, that being said, we're still significantly off on the market. And there's a number of reasons for that. Some argue that it has to do with the availability of credit or people not having the ability to get credit. But I think there's more and more mounting evidence that it really has more to do with people not wanting to buy or being locked in because of negative equity, for example, and not being mobile and able to buy. And all of these are driving house sale volumes lower to a very de minimis amount. When you add to that refi activity, which is also declining, most people who have had the ability to refinance probably have already done so at the historically low rates, and so that's also a dwindling share. It just means that there's very little activity out there over the years to come. And, the problem here is when we bring stuff into the foreclosure stock, obviously we want to have a robust market to absorb it on the other side, and that's not there in 2011. When you go on to looking at how does that play out actually in terms of foreclosures, we look at three different elements. One is obviously the stock of active mortgage loans that are 90 or more days delinquent. That's the blue line. And that has risen up to about overall 8% at its peak and is now, or 8.5% at its peak. It's now dropped down below 8%. That's in part because of an improving economic marketplace. Obviously, people losing their jobs means usually transfers into delinquencies, and since we have fewer job losses and minimal job gains, that risk is subsiding as the economy improves, but also because this is a measure of active loans, and foreclosures are basically pulling loans out of the denominator. A lot of the foreclosures obviously started out as 90 or more day delinquent loans, and so part of the decline is also a function of the clearing of the distressed assets through the market. We also look at sort of the next step along the process, which is the foreclosure filing rate. That's really auction filings in the public record, measured on the left-hand axis, on the right-hand axis, in terms of volume per month. You can see that there was a strong relationship as delinquencies rose. Also, so did foreclosure filings, which is basically when the individual is removed from the house with the auction or the sheriff's sale in the courthouse steps. That's usually what it's referred to as. This is a little bit different. These numbers can vary depending on who you're talking to. There's also such a thing as pre-foreclosure filing, which is a public record notification that's done not in all states in the U.S. but in many states to the borrower saying that if you don't start to pay your mortgage, you will be foreclosed upon, and in fact you can have multiple pre-foreclosure filings. So one has to be careful to make sure that when you're analyzing this that you effectively deduplicate your data, because you can have multiple pre-foreclosures and a foreclosure really indicating one single event to a property, that is the individual being foreclosed upon, and not all pre-foreclosures necessarily move to foreclosure filing. So we really focus on the foreclosure filing estimate. Now, about 2 months ago, I did a very simple forecast that trended out the rate at about 100,000 foreclosures a year for 2011, which would indicate about 1.2 million for the entire year. That forecast is already more robust than what we're actually seeing in the last couple of months. The foreclosure filings have actually declined. And as you can see, the foreclosure percentage, that's the stock of active loans in foreclosure, is not declining because we've reduced the rate pace at which we are basically keeping stuff in the stock and not selling things out the other side as REO.
Mark, what would you assume the ratio of foreclosure starts to sales would be? I had heard the figure of 3 to 1. That starts outnumber sales 3 to 1. Does that sound about right?
Yeah, I mean, it will vary greatly depending on, so all sales 3 to 1, so we'll foreclose on one person for every 3 sales. I don't know what the current number is. Obviously, the sales numbers are going down, and foreclosure filings, while they are going down a little bit, should remain high. In fact, if we trended the green line out there along the same line as the blue, we would expect something like 140,000 a month. But it is clear that we probably could be foreclosing more often, or that the relationships relative to the foreclosures to clear the market would indicate a higher pace of foreclosure filings, but obviously a lot of policy intervention and issues with addressing options other than foreclosure are holding up that stock of delinquent loans from being foreclosed upon. And the ratio relative to sales is probably very volatile because of the sales side of the market.
And I also wanted to ask you, hopefully I didn't miss this because my headset fell off, but your definition of shadow inventory and why everyone continues to call it shadow.
Sure. Is there, we move on to the slides for that? Is that the next one? Okay.
Actually, I think it is.
Yeah. So first of all, we define the generic English version of the definition of shadow inventory is generically those homes that are not yet in REO. You have to be in REO to be part of inventory. Not yet in REO, visibly listed, and due to some reason. And so the question is, or the big differences that occur in sort of that definition of what defines the bucket of loans that you start with as distressed that would be likely candidates to move through into that REO process. And our definition is 90 or more days delinquent, so you have to be at least 3 months late. And then on top of that, we use our data to estimate the transition or the roll rates from delinquency into foreclosure, which have been volatile in the last couple of years due to the policy programs. For example, the transition from delinquency to foreclosure has been reduced by the modification program. And so we use that transition rate to effectively haircut the share of the 90 or more day delinquent loans that we think are likely to roll into foreclosure, and then we basically do a same sort of roll rate or transition rate analysis of those that are in foreclosure already and whether or not they will roll into REO. Now, that roll rate is significantly higher, but it's not necessarily 100%, and that will wobble around. And then finally, we take the REO stocks that we know about of active loans, and we use our MLS data to sort of haircut that for likely shares of the REO inventory that are listed. All that being said and done, we end up with an estimate of somewhere north of 2 million units of likely shadow inventory in the next 1.5 to 2 years. Our estimate is actually very much on the low side. As I said, a lot of that has to do with the definition of where you start in terms of the definition of delinquency status, as well as obviously accounting for something we don't account for, which is those that are current today but may well become delinquent over the next couple of years. And I think that's an important component that we don't actually include in our shadow inventory.
Why do you think it's better to err on the lower side? Because a lot of firms don't.
I don't know that it's better to err on the lower side, just to sort of be clear about how you do it. Ultimately, I don't think any of us really know what the right number is, so it's an exercise in bracketing. You take ours, you take the high end. The truth is probably going to lie somewhere in the middle there. I think what's more important than being less or more conservative is to understand that, okay, even looking at this chart, forget the magnitudes. It is clear that the shadow inventory is significantly higher today than it was in '06, and is significantly higher than it was in '02 and '03 and '04 and '05. This is a fundamental issue that the housing market has to face, which is the ability to over time, absorb these distressed assets as they come out of the shadows and into the visible inventory, which will be something that plays out over a number of years to come.
Thanks. Okay, Laurie, we're going to turn it over to you.
Yes, thank you very much. Slide 11. And Mark did a great job explaining his definition of shadow inventory. We are on the very, very high side of the market, so what I'd like to do is walk you through our numbers and sort of talk about the differences between Mark's numbers and our numbers. Realize that Mark and I are both using exactly the same data. We buy our data from CoreLogic. They do a very nice job. The bottom part of slide 11 shows you the breakdown of the private label securities universe. We break it down into non-performing loans, that is those that are 60 or more days past due, re-performing loans, and you'll notice I'm using 60, not 90 as Mark did, re-performing loans, those loans that used to be 60 days past due and are now either current or 30 days past due, and three categories of always performing loans, greater than 120 mark-to-market loan to value, 100 to 120, and less than 100. We do the same breakdown on the non-PLS universe, which we extrapolate to the market as a whole. And on the non-PLS universe, that is bank portfolio loans, GSE loans, FHA, VA loans, we don't have the complete sample. We extrapolate that to the market as a whole, and we may differ slightly in terms of what percentage of the market is covered, because nobody really knows what the total number of homes in the U.S. with a mortgage is. Everyone's got a slightly different estimate. And then in the top part, we add it together. So let's actually look at each of the numbers in the top part of this page. Non-performing loans, 4.8 million loans, 60 or more days past due. So what percentage of these loans will ultimately default? And again, we're using a fairly broad definition because we're going to count not only the non-performing loans, but also some share of the loans that are current that haven't yet defaulted, but we assume will default. But let's first focus on the non-performing loans, those 4.8 million units. And please go to slide 13. This shows you the performance of the non-performing loans 24 months ago. 12 and 24 months ago, where are they now? So look at the top section of this page, the bottom line. Non-performing loans 24 months ago. 54% of them have been liquidated. 36% of them are still non-performing. 9.8% of them are re-performing, and 0.1% have voluntarily prepaid. So we can define a success after 2 years is if the loan is prepaid or is still re-performing. That's 9.9% of the loans that were non-performing 2 years ago. So consequently, we assume a default rate of 95% of the non-performing bucket. That is, we assume after 2 years, only 10% of them are still alive, including those that received a modification last week. Now we can do the same thing for the re-performing bucket. There are 3.4 million re-performing loans, and Toni, if you can go to slide 14, that's one slide. You'll notice that on the re-performing loans, these loans are re-defaulting at around 50% per annum. And that's sort of regardless of category, whether it's prime, alt-A, subprime, or option arms, you've got pretty much a 50% re-default rate on these loans. If you can flip back to slide 11 for a second. you'll notice on these slide 11, these 3.4 million re-performing loans, the aggregate transition rate for the universe as a whole is 52%. That is, these loans are re-defaulting at 52% per annum. They're voluntarily prepaying at 3%. Now, normally mortgages don't pay on schedule all the way to maturity. They either default or prepay. If these ratios continue forever, the ratio of defaults to defaults plus prepays is around 95%. That is 51.9 divided by 51.9 plus 3 gives you a 95% default rate. And you can see that under the D divided by TV ratio. We're going to assume that 70% of these loans are going to eventually default. How did we get 70%? Well, again, it's guesswork. If you flip to page 12 for 1 second, page 13 for 1 second, you'll notice that, page 13, sorry, you'll notice that at the bottom line on the page, 46% of the loans that were re-performing 24 months ago are still alive. We're going to haircut that number a little bit more. So again, a 70% survival rate. I'm sorry, 70% default rate, 30% survival rate on these re-performing loans. Now let's go back to page 11 one last time, and let's look at the always performing loans. 3 categories of always performing loans: greater than 120 mark-to-market loan to value, 100 to 120, and less than 100. Of the always performing loans greater than 120 mark-to-market loan to value, these loans are defaulting, these loans are going 60 plus at 17% per annum. So again, borrowers who have never before been 2 payments behind, who have been paying for a period of time, are going 60 plus for the first time at 17% per annum. The voluntary prepay speed on for these borrowers is 7.3%. If nothing changes, 70% of these borrowers eventually default. We're going to haircut that number to 50%, assuming that transition burnout is assuming some amount of transition burnout. Always performing loans, 100 to 120 mark-to-market loan to value. 9.6% of these borrowers are going 60 plus for the first time on an annualized basis. The prepay speed for this bucket is 14%. If nothing happens, 40% of these borrowers eventually default. We're going to haircut that number to 25%. Always performing loans, less than 100 mark-to-market loan to value. These loans are defaulting, are going 60 plus for the first time at 3% per annum. They're voluntarily prepaying at 26% per annum. If nothing happens, 10.5% of these borrowers eventually default. We're going to haircut that number to 5%. So when you add this all together, what you find is that there are about 11 million borrowers in danger of losing their homes. That is, if you multiply the number of loans by our estimated default rate, you find that there's about 11 million homes in jeopardy. 4.6 million of those are already 60 plus, or further along in the process. The remainder are loans that are still current or 30 days past due, but that are likely to default in large part because of negative equity. Now, when you look at my always performing bucket at the bottom, you can say, well, gee, these loans are less than 100 mark-to-market loan to value. How can you say they're likely? How can you say they have negative equity? Well, a lot of them do because we're looking at loan to value, not combined loan to value. We were unable to match the first with the second on the non-private label universe. So what you have is loan to value. A borrower could have 95% loan to value and 120% combined loan to value. The behavior you're picking up is the behavior of the combined loan to value bucket. So again, the takeaway from this slide, 11 million borrowers in danger of losing their homes if nothing changes. Now, if you could advance to slide 12 for 1 second. The reason we divided the always performing borrowers into 3 buckets is because the borrowers that are severely underwater transition at a very rapid rate and default at a very low rate. The borrowers that have equity transition at a very low rate and prepay at a very high rate. So let's look at slide 12. This shows you prime borrowers less than 100 loan to value. These borrowers are prepaying about 30% per annum. They're transitioning to default, that is going 60 plus for the first time at 3% per annum. Prime borrowers, 100 to 120 loan to value. These borrowers are prepaying at 10 and transitioning about 8. Prime borrowers greater than 120 loan to value. These borrowers are prepaying very, very slowly, 5% per annum, and they're transitioning to default at 15% per annum. Remember, if you're transitioning to default at 15% per annum and you don't transition this year and you don't prepay either, you get another chance to default next year. So again, the differences between my 11 million and Mark's much, much lower number is primarily the fact that I have included loans that are current, that is in either the reperforming bucket or the always performing bucket, but that are likely to default. My definition of non-performing includes loans that are 60 plus, and my haircuts are somewhat higher than Mark's haircuts.
Laurie, your research deals primarily with non-agency. Have you ever compared your statistics to agency performance, and are the dynamics any similar? Or Mark, have you done that?
If you could actually let's go back to page 11 for a second. Flip back one slide. What you actually have is a comparison in the if you compare the middle section to the bottom section. The bottom section is, of course, private label. The middle section combines agency plus agency, FHA, VA, and bank portfolio loans. It's hard to get very good default information from the agencies. But what we've done is we've used the CoreLogic prime servicing database to do this. The first thing you'll notice is the difference in terms of the number of non-performers. 32% for the private label universe versus 7.4% for the non-private label universe. So your distribution by balance is very, very different. That is, the private label universe is far more adversely selected. But then, when you look at the transition rates, they're a little bit higher in each category for the private labels than for the non-private labels, and the prepay speeds are a little bit lower, but the differences are far more muted there than in terms of the composition.
Thank you. By the way, Paul, anytime you want to jump in, feel free to ask questions.
Well,
you're a little quiet.
I'm just, we've been through this on the practice side, and the one issue that I've asked both panelists, Mark and Laurie, was these are just big numbers. I think 11 million is almost 20% of the mortgages in this country and 10% of the housing stock. And so, therefore, how long would it take to get through all this? Is it 3 to 5 years, given the fact that home sales are on the decline, or is it longer than that? I think that's the big question I think everybody wants to know. I think we tell our clients that even though the banks are probably in a better condition than the private label, even the GSEs, so it could be adverse selection, it's just these numbers are, the 11 million that Lloyd throws out there, it's a number that is a scary number. So, Laurie, do you think that we can be through this in 5 years, or is this going to take longer than that, or you think the government has to step up and do something?
I think the government has to step up. I think you can't throw one borrower out of every 5 out of their home. I believe there's going to be modification program after modification program after modification program until you end up with something that's effective. It's hard to say exactly how long it takes to get through this. I mean, this assumes sort of a home price static. That depends on how quickly you dump homes are dumped on the market. It also depends on what happens to inflation. But I think that my numbers are a theoretical impossibility, and just point to the fact that you're going to need more governmental action.
I would suggest that it's looking forward. It's hard to say. I would hope. Maybe I don't have any models or data to prove it, but I would hope that the default rates come down as the economy improves, people's behavior towards their houses changes, as house prices stabilize and begin to grow in the next couple of years, that their behavior changes. And so all of those folks who are active or only moderately underwater, stick to, don't become part of the default shadow inventory as a function of things improving over the next couple of years. And a lot of it is really behaviorally perception-driven at this point. And if people perceive that there's value in that house eventually, which they may not be perceiving right now, but maybe in a year or so they would change their tune and they would feel better about the economy, that things would improve from that perspective, and not all 11 million of these people end up in the shadow.
Paul, you went ahead and brought up timelines, so I want to revert to Mark to come back to this on slide 15 to discuss distressed asset geographic concentration.
Sure. So it should be no surprise, obviously, that the delinquencies or the distressed assets that are out there are not uniformly distributed across the United States. When we do this map, this is as of January, the share of active loans that are 90 or more days delinquent. The sand states immediately come to the fore as having high levels of delinquency. There's really been a double whammy in those states, which is these are all places that experience a significant housing price run-up, and so the popping of the housing bubble has, of course, influenced them with very high levels of negative equity share. In fact, Nevada's #1, I think Florida's #3. California's tied with Michigan at 4 or 5 or something like that for overall negative equity share. Nevada, almost 70% of all mortgaged homes are underwater. And then the double whammy part is combined with the fact that many of these same states have very, very big construction-oriented industries, and so when the housing bubble popped, the house building industries or the construction industries in those markets were severely affected, and so they've had, disproportionately more severe economic recessions because of their concentration on that housing-related industrial sector. That's a little bit different from, obviously, the more post-industrial sort of manufacturing states, the oranges up in the top, Illinois, Michigan, New York, Ohio, Indiana, and then the textiles or manufacturing down south. Those are really much more long-term high levels of delinquency due to long-term economic distress, much less house price appreciation. In fact, Michigan really has no house price run up, and so any house price run down can be significantly painful. So, it's not that it's geographically diverse across the U.S. It is actually concentrated in a few states. You go to the next slide, please. One of the things we actually look at in terms of doing this analysis is, on slide 16, is the transition of foreclosure to distressed sales. This is not rocket science. All I'm doing here is dividing the contemporaneous pace of REO sales with the pace of foreclosure filings. The idea is that this tells you whether or not the stock of assets in foreclosure, which are most likely to become REO assets or become distressed assets coming out in the shadow on the other side, is that stock growing or falling? And any number below 1 indicates that you're counting more foreclosures in a month than you are REO sales. It's not all sales, of course. And so therefore the stock is growing. And as you get up to 1, then basically you're sort of doing about the same and the stock is stabilized, and anything above 1 obviously indicates that you're dwindling the stock. And it comes as no surprise that as we ran into this recession, we had a fair amount of foreclosures going in, but interestingly, our pace of moving them through and actually generating the REO sales on the other side, sort of preventing the stock from growing too quickly, actually increased over time until about the early part of 2009. At that point, it dropped back down again significantly to about 50% or just under 60% share, or basically we're doing 6 REO sales for every 10 foreclosures at the moment. And that means that the stock is growing. Now, it's coming as a combination of really 2 things. One is not just purely that we're doing more relative foreclosures to REO sales, but that the share of REO sales has also slowed. So even though we've had a slowdown in the foreclosures, we've had an even larger slowdown in sales activity as a whole, and REO sales as a component of that, and so the stock is actually growing. if you go to slide 17, you can see the geographic distribution. Basically, the markets that have lower percentages are those which have faster-growing foreclosure stock. So you again see an obvious picture of the places where the stock of assets in foreclosure is rising faster than in other places, and it correlates highly, obviously, to the delinquency trends, but you do see some differences. In other words, for example, Florida is doing a little bit better of managing the growth in its stock of foreclosures than, say, California is at the moment. But again, you see the sand states and the Midwestern states coming to the fore. And then the healthier states, those that are seemingly clearing their markets or actually reducing their stock, are relatively small states in the scheme of the U.S. national market.
Laurie, we were going to go to you to talk about liquidation lag times.
Yes, slide 18, please. What you'll notice is that liquidation lags have been extending very, very dramatically. So if you look at the top left-hand slide, what this shows you is on average the liquidation lag, and this is the lag from the borrower's last payment to when that loan is liquidated, is now 22.7 months. It's higher in Florida and other judicial states than it is in California and other non-judicial states. The top right shows you the percent of liquidations that are more than 24 months delinquent at liquidation. So for Florida, more than 60% of the liquidations, that loan has been in the delinquency foreclosure REO pipeline for more than 24 months. For California, that number is running about 38%. Now, if you look at the bottom part of this slide, what we've done is we've divided the liquidation lag into three pieces. Months delinquent prior to foreclosure, the months in foreclosure, and the months in REO. So you'll notice on average for short sales, foreclosure sales, and REO sales on a weighted basis, the months DQ prior to foreclosure is about 12 months, about 7 months in foreclosure, and about 4 months in REO. When you look at, and then what we've done is we've broken it down separately for Florida and California. They are in the all numbers, but we have broken those down separately. So you'll notice for California, which is a non-judicial state, for REO sales, months DQ prior to foreclosure is about 11 and a half months. For Florida, it's 10 months. Months in foreclosure, 6 months in California, 16 months in Florida. So the real issue is in judicial states, it takes a very, very long time to get the borrower out of the home, and that extends the foreclosure timeline very dramatically as the courts are so very backlogged. But realize how much overall you've had in terms of an extension. It takes 23 months on average from last payment to liquidation, with most of that in the delinquency and foreclosure periods where the borrower is still in the home. And realize also that I've got a certain amount of measurement error in these slides, because I'm calculating these slides by looking at what has been liquidated in any month. So I'm missing that Florida loan that has been in 90 plus for 30 months and hasn't moved into foreclosure, that's got a long remaining pipeline. So if you move to slide 19, one way to see the slowdown, slide 19 please, is to look at what percentage of loans of any given age are liquidated in a given month. So if you look at, say, 21-month-old loans, you'll see in 2008 we were liquidating about 10% of those loans per month. Now we're liquidating about 3% of those loans per month. So the liquidation pace has gone down very, very dramatically, and we're actually overstating when we look at the loans that have been liquidated, because those are, you tend to liquidate the easier to liquidate loans first. So I just want to, emphasize how very, very much that liquidation pipeline has stretched out, increasing the cost of foreclosure.
Hey, Laurie, this is Paul. On a lot of this drag, is this mainly private label stuff? Is this GSE?
This is all private label. This is all private label. It's very, very hard. Our data for non-private label is relatively poor, and in many cases, we lose that non-private label loan when it goes REO. So our best data is for private label. This is exclusively private label.
And I know for the GSEs, which is a non-private label, they have a hard, they're not really letting investors buy the homes, which is slowing down that process. And on the private label, has there been a lot of bulk sales, or has that been not really a major factor?
You're getting so few loans you've got a huge backlog in the foreclosure buckets. So the loans just aren't making it into the REO, aren't getting into the REO classification. Once they do, they tend to move reasonably quickly and reasonably consistently through a combination of bulk sales, individual sales, etc. And by the way, the short sales are in my numbers as well, and as Mark mentioned earlier, that's a growing but still small percentage of the total.
Well, I get back to the point that if it's slowing down, one of it's definitely the robo-signing, the increase, the AG lawsuits and whatnot on moving the properties through. But if this is slowing down, I mean, this just drags out this process even longer.
Yes, it does. And that's a really big issue because you just don't give the market a chance to clear.
Laurie, could you address dual track?
Sure. Dual track is where you allow the servicer to both pursue a modification and pursue a foreclosure at the same time. The consumer groups hate dual tracking because it's very confusing to the borrower. They think they're getting a modification, and in fact, they receive a foreclosure notice. It's important to realize, though, that what dual tracking allows for, if you eliminate dual tracking, you have further stretching out of the liquidation timeline. It is not dual tracking in and of itself that is confusing to the borrower. It's really the fact that you don't have a single point of contact. So if you had a single point of contact and you allow dual tracking, the single point of contact from, say, Bank of America could call Toni, you as the borrower, and say, well, gee, I just want you to know that we are proceeding with your modification. You're going to receive a foreclosure notice, but don't worry about it, because if your modification succeeds, that foreclosure notice is going to be null and void. But just in case it fails, this is going on, but again, don't worry about it. And if you have that single point of contact, can explain. So I don't think it was necessary to eliminate dual tracking as the Attorney General's term sheet proposes to do. And by the way, that's nowhere near done. I mean, that's just kind of a proposal.
Yeah, and a lot of services, as Paul Miller told us, that without dual tracking, you really can't get the borrowers to really work with you. It's hard to get them to pick up the phone and call you unless they know there's a foreclosure process taking place behind the scenes.
Right, it's a really good, a bunch of the issues here around modifying and principal forgiveness and all of these things there's the moral hazard risk, right? And so by doing something like proceeding with the foreclosure, it creates that, it mitigates that moral hazard risk because you're putting some pain or some potential risk of negative things happening by proceeding with the foreclosure to incent that borrower to reveal himself as seriously wanting the mod.
One of the participants just wrote in, I think I know who it is. We found that without the dual tracking, there is no carrot and stick approach to incent the borrower to work with the servicer. Laurie is correct. The single point of contact is the key, as the servicer's systems frequently do not speak to each other. Which also brings up a really good point, Mark, that you've talked a lot about in terms of the magnitude and timing and orderliness of liquidations of REOs. The servicers have massive operational challenges to begin with, simply due to volumes, and then they're completely exacerbated by this continuing barrage of legislation, which appears to just be increasing. Can you address that?
I mean, I don't think any servicing shop that was out there prior to the events of the last couple of years was in any way prepared to handle the volume, even in a simplified world of either the guy's performing and we don't worry about him, or he becomes non-performing and we foreclose. It was a very simple binary world in which servicing tended to live. So to not only increasing the volumes dramatically, but also, opening the hood of the car and trying to tinker with it and add in all these other options along the way. And that's been a significant operational hurdle, I think, for most servicers. And all of these things slow down the process, which in one way is helpful. Is sort of, is viewed as, okay, well, we've just got to rip the Band-Aid off quickly and get through all of this and move on. And there's certainly, positive aspects to that. But then by the same token, a fragile housing market is actually benefits from, a reduction in the pace of foreclosures and REO sales and stretching it out over more years because the market over time will be more able to absorb it. So it's impossible to say.
On the other hand, I'm interested in all three of you answering the question. If you had a substantial inventory of REOs, would you rather have today's price and liquidate or tomorrow's? Laurie?
I'd rather have today's price because I think at least in the near term, there's more downward pressure on prices because of the shadow inventory, no matter how calculated.
Paul?
I agree with Laurie. I think you try to get the price the best price you can get today. I think most banks and individuals try to hold on for a better price down the road, and it's always turned out to be a mistake.
Mark, would you agree with that?
Yeah, I think that's true. Behaviorally, this is how we act. Is when we've got an asset that's undervalued, we hold on too long. So we do it with stocks. We do it with in many instances of our of our behavior. This is how we do things, but. I think I would be not necessarily rushing things through the door, but I believe that when you do the net present value calculations of all the alternatives, that there are better alternatives out there that we are underutilizing today than foreclosure, than even modification, deed in lieu, principal forgiveness tied to equity sharing. These are all potential options that would help us address the issue without necessarily having to rush everything out the door and into the market.
But you bring that up because because Laurie talked about the other thing about the modifications, but when you have so much negative equity, who's going to pay for that modification, or is the market's already absorbed it? Because I don't think the taxpayers want to pay for it. The banks don't have the money to pay for it anymore. But everybody throws around modifications. Who's going to pay for it?
Basically, there is a cost to any modification, whether it be a principal reduction or whether you reduce the interest rate. And the person who's prepared to pay for it is the investor, because basically you're doing modifications, hopefully only when they're net present value positive. The costs of foreclosure are huge. If you just look at, and I hope I'm not jumping on this, Tony, but just look at 521. This just basically starts out with a $500,000 loan. We're assuming that we're able to sell it for 85% of market value, which, the 15% foreclosure discount where your index includes both distressed and non-distressed sales. If you're actually just doing it off the non-distressed sales, it would be an even bigger discount. And then this is in a private label example. You're advancing principal and interest, which you would not advance if it were a bank loan. You're advancing taxes and insurance. Obviously, when the home is vacant, or if the borrower isn't paying, something happens to the roof during the snowstorm, and you have to replace it. You have to mow the lawn, and you've got foreclosure costs, and you've got fixed costs of liquidation. All together, in this example, where I've assumed a fairly generous gross recovery, 85% of market value, we have a loss severity of 55%. Even if you eliminated the principal and interest advances, it would still be over a 40% loss severity. You would far rather modify this loan, if you could do a successful modification, than you would incurring the cost of a foreclosure, because it's really quite expensive, as you can see here.
Which begs the question: why not more short sales? Particularly after we've discussed the timelines of 2+ years. You're trying to calculate, if I proceed into foreclosure with this delinquent borrower and the REO process, I basically have to forecast where I think house prices will be in 2 years, which is when I'm going to be selling this thing. And the carrying costs for that period of time and all of these things, it seems that short sales should, from a net present value test perspective, absolutely the day a lot more than we're doing them.
I agree with you 100%, Mark, and I think part of it is that the short sale process has just become very, very regimented and very, very cumbersome. And certainly, when you look at sort of things you can do, I think you mentioned a couple things. Streamline the short sale process, make deeds in lieu easier to do. I mean, I think those are things that would definitely help a lot.
But that all comes back to, right, I mean, how many realtors have you met out there that want to do a short sale? And I think that's part of the problem. It's not streamlined. But all these things carry a cost at the servicing function, which I don't think the banks really want to invest in. And I think that's one of the problems is that, this is a giant expense out there. They're trying to be as cheap as possible to work through this process. That's because that's what banks do. They're amoral. They're a business. And the problem is they don't want to streamline and they don't want to invest into this policy. So you got to get the banks or some more investment into the servicing process to make it more valuable to do a short sale rather than it's more profitable for a servicer to do the foreclosure.
We had a question, and I'd like to go back and revisit this again just for more clarity. But how long were the three of you predicting it would take to work through the inventory in terms of liquidating the inventory? How many years?
This is Paul Miller. I think it's going to take at least 5 years to work through this inventory.
I'm sort of in the 4 to 5 year range as well.
And Mark?
5's good. I mean, every year we do, we work it off. There's still more stuff coming in, and this is a dynamic problem. It'll probably take 4 to 5 years at least to kind of get back to inventories of distressed assets that are more in line with historical norms. We've experienced the worst housing. We've experienced in the housing market the equivalent of a Great Depression. And so, it's going to take a long time to deal with it. Negative equity alone, in most markets, is going to take up to 10 years. And in the more deeply hit markets, well beyond that. But we're going to be dealing 15 years from now with people who are still underwater.
Wow, that's a perfect segue into this final portion, which is who's going to pay the costs. So if we could go to Marcus, slide 22.
Sure. So, as I was just mentioning, looking back at house prices and where they've gone, ignoring the blue line, which is the month-to-month change, just shows the volatility of prices over the last couple of years. But looking more at the red and the green, would say our red all transaction index, where we include distressed sales, REO and short sales. You can see that it started in 06, where prices peaked. It wasn't until early 2007 that house prices actually started going backwards. They were slowing down their pace of increase in that first part of the year. If people recall, the subprime lenders started having problems in the late summer and fall of 2007. The crisis really started to wind up in 2008 as the house prices began to fall dramatically. The end result of this is we've worked off about 30% cumulatively from peak, and prices are again declining. This is obviously driven by weak demand. We've already talked about that. Negative equity that we've already touched on, and obviously this pressing at inventory within the sales that are occurring. Many of them are distressed types of sales, which are all pushing prices down. And so most economists are forecasting somewhere in the order of a 5 to 10% decline in prices this year, which would put us in the mid-30s in terms of cumulative losses from peak. And, this just goes to the point of, we probably never should have been at the peak, but having come off that, it's going to take a long time for many of the markets to work these kinds of issues off. If you go on to slide 23, you can see where we've basically taken our negative equity distribution, or really more holistically, the entire equity distribution of mortgaged homes by state. While this chart is a little bit tricky to read, the idea is safer or less risky states have lines that more quickly accumulate out to the outer edge of this phytograph. So if you take as an example New York, which is the outermost line, about half of all loans have less than a 50% combined LTV today. And if you go all the way out to about 7 o'clock on this chart at the 100 to 104 mark, practically everything in this distribution is already accounted for. So there's very little negative equity in a state like New York as well as in a state like Texas. Conversely, you compare that to Nevada, who is the most innermost ring, and you can see when you get out to that 7 o'clock spot to them, there's still a significant share of homes homes that are above 100%. And if you work your way out to where it's at about 10 o'clock on the curve, you can see that even then there's a significant share of negative equity that's even above 125%. And the reason we focus on not just overall negative equity, but the depth of negative equity is really behaviorally the issues of strategic default and really what am I going to do about my housing asset come to bear, even if you can afford to pay your mortgage or have a capacity and essentially you're questioning your willingness of whether or not to pay when you're so deeply underwater. And that's disproportionately in a couple of states, Nevada, Florida, California. But, these are the types of situations that this chart is representing, people who are going to be faced with this problem of not being able to move, not being able to refinance over the next 10 years, and that's going to be a continuing drag on recovery.
Mark, what would the impact be of principal reduction?
Well, if you can go to the next slide. Summing the things up a little bit more simply here, if you look at the distribution in terms of dollars, those mortgaged homes that are underwater by 50% or more, arguably the set were potentially most incentive to strategically default, least incentive to have continued willingness to pay, least incentive to, when addressed with capacity constraints, choose to pay the mortgage over other alternatives. We see lots of data that tells us that people are choosing to pay car payments and credit cards instead of mortgage payments today when they hit capacity constraints. There's deep negative equity combined with that. Well, that's $450 billion worth of homes. So it would be very, very hard to, this idea, it's very, very costly of the $750 billion total dollars of negative equity out there to, wipe away all of that. There's not enough money in this country to do that. So the question then really becomes, well, who do you select? We have limited resources and we want to do some sort of principal reduction. Who do we select and how are those costs borne? The main point of this slide really is that, these are significant costs, and the introduction of the idea of selection brings in issues about how you do selection and the moral hazard risks of how you set up these programs, which are very, very significant.
Let me just jump in there. We've been huge fans of principal reduction. We realize that you can't save everybody with a principal reduction, and furthermore, a lot of these borrowers don't want to be saved. That is, they can't afford to live in their home, even if you gave them a rather significant principal reduction. So, you're not going to be able to save, $750 billion saves 11 million borrowers, but, maybe the number of borrowers that you can save is something like 3 million. The Attorney General's proposal on a settlement amount for the banks was sort of 20 to 25 billion. Yes, that doesn't go a very long way, but the banks were never intended to pay for principal reductions for loans where they don't own the risk. It was meant to be a penalty and a start. Clearly, the investors have to ultimately fund this, and banks fund it on the loans that they own in portfolio. Freddie and Fannie and the mortgage insurers fund it on their loans. Private investors fund it on their loans. The key point here, though, is that a successful modification, be it principal reduction or something else, is going to be far less costly than other alternatives where you, and in particular those alternatives where the borrower is forced to move out of the home. What I'd like to do is sort of make a little bit of a case for principal reduction at this point. If you could turn to slide 25. Yeah, I think basically what HAMP did, what the President's Home Affordable Modification Program did, is it provided a blueprint for more significant mods. You'll notice that the share of modifications by product type is definitely changing. You're getting more principal reduction mods, although a lot of these are principal forbearance rather than forgiveness. You're getting more rate mods, and you're getting fewer capitalization mods. In a capitalization mod, you just take whatever amount the borrower is delinquent by, add it to the balance of the loan. You've essentially done nothing for the borrower. When you look at redefault rates over time, what you see is that mod experience appears to be getting better. We think part of it is the fact that you're doing more significant modifications now than you were before, but part of it is that trial modifications don't count. If you go back to 2008 and early 2009, there were very few trial modifications. Generally, you went straight into the principal and interest advances were recaptured immediately by the servicer, and the modification time clock started ticking at the beginning. Now there's a 3-month trial period, and if you flunked out during the trial period, that doesn't count. So the redefault rate appears to be improving for that reason as well, because a large number of borrowers flunk out during the first 3 months. The trial period has become standard both in the HAMP modifications and also in the private modification programs. If you turn to page 26, you see slide 26 is the problem with the HAMP type modification or rate type modification programs. Under HAMP, the borrower's front-end debt-to-income went from 45% before the modification to 31% afterwards, which is a drop of around 32%. That's a very significant drop. However, the median back-end debt-to-income, that is front-end debt-to-income is taxes plus insurance plus the first mortgage payment. The back-end DTI, the borrower's total debt burden, went from 79.2% before the modification to 62.4% afterwards, which is an absolutely unsustainable level. You can't sustain a 62.4% back-end debt-to-income, paying 62.4% of your total income to debt payments. Meanwhile, HAMP has increased negative equity modestly. Median LTV ratios under HAMP increased from 120 to 125, and this is LTV ratios, not CLTV ratios. So basically, I think that's very, very important. So when you look at the failure rate under HAMP modifications, they're quite high if you add back in what doesn't make it through the trial period. Now, what do you need to be effective? What you need is you need principal reductions. Banks have screamed, gee, can't do principal reductions, moral hazard, moral hazard, moral hazard. But I just want to show you some numbers on this slide that's on the screen now. Look on the right-hand side of the page. This is percentage of each type of modification by investor in the third quarter of 2010. These aren't my numbers. These are OCC OTS numbers. Banks, for their own portfolio, did the principal reduction about 25% of the time. That is, normally when anyone does a modification, there is more than one feature. So you may capitalize, you may reduce the rate, and you may do a principal reduction. The principal reduction was used 25% of the time versus 0.2% for private investor loans and 0% for Freddie, Fannie, and government-guaranteed loans. Obviously, for Freddie, Fannie, and government-guaranteed loans, banks oftentimes don't have the flexibility to do principal reductions, but they certainly do for private label securitizations. So, nonetheless, look at that difference between 0.2% on private label loans versus 25% on their own portfolio. Realize also that the success rate on bank portfolio loans is much, much higher than on other types of loans. If you look at the bottom section of the page, you can see 18% of portfolio loans have redefaulted 6 months after modification versus 28 to 42% for other types of loans. 12 months after modification, 30% for bank portfolio loans versus 52 to 62% for other types of loans. So basically, principal reduction is by far the most effective means of modification. Now let's talk about the moral hazard problem for 1 second. If you look at slide 28, let me just tell you that there's a moral hazard problem in the current program as well. What this slide shows is the transition rates of always performing loans by occupancy status. Now remember, the modification program began in earnest in early 2009. Prior to that, look at the prime picture. Owner-occupied and non-owner-occupied borrowers transitioned at roughly the same rate. That is, we're measuring the rate at which borrowers who have never before been 2 payments behind are going 2 payments behind for the first time. You'll notice those rates were very similar between owner-occupied and non-owner-occupied borrowers. The modification programs happen, and what happens? The transition rates on owner-occupied borrowers who are eligible for this program jump dramatically. The transition rates for non-owner-occupied borrowers increase much, much less. Same thing for all-day same thing in the all-day world. That is, you've already got moral hazard. Now, the argument is, well, principal reductions have a lot more moral hazard than just reducing the borrower's rate. Well, there are ways to combat that. First, we have to stop thinking about it as moral hazard and start thinking about it as a borrower who is severely underwater is most likely going to default anyway. What we want to do is we want to introduce a series of frictions so that those borrowers who do the modification can get one, but it's not without penalty. So I think Mark mentioned this idea earlier. You do either a shared appreciation mortgage or you have a tax on any future appreciation if you accept a principal write-down. I like the idea of earning that principal write-down over time, over a 3-year period seems reasonable. Now let's go back to some sort of a shared appreciation feature with either the lender as your partner or the government as your partner. I have a 120 loan-to-value rate. I would say a 120 combined loan-to-value ratio on my home. I look at my neighbor across the street who's just gotten that principal reduction because he's got a 150 LTV and he was going to default anyway. At 120, I say, you know what, I don't really want to do the shared appreciation feature. I understand why he got the modification, but I'm not willing to bear those costs. So again, sort of thinking in terms of putting into place the economic frictions that give those borrowers who need the modification or who need the principal reduction, but that it's not without cost. To those borrowers who don't need it, opt not to take it. And oh, by the way, when we're talking about moral hazard, when you look at these pictures, there is just an incredible incentive to default to be able to live in your house for several years rent-free. Taxing the imputed benefit of the rent the borrower isn't paying is also a public policy measure that we should seriously consider as well.
Well, we need to wrap up here. So, in conclusion, based on the magnitude of the problem, who do you guys think should ultimately bear the cost burden?
This is Paul. No, I think that the investors will probably bear the bulk of it. I think it's going to be very difficult to get banks to pay more. I think that there's going to be a lot of private lawsuits to do it. But I think the banks have been recapped and the ownership has changed drastically, and the new owners really weren't responsible for what happened in the past. And I just don't think the taxpayers are going to step up to do it. I think that, I think I said a long time ago, 2 years ago, that the only way to get out of this mess quickly is for the government to modify everything down quickly as possible and move on. But that didn't happen. That was not politically feasible. So, unfortunately, Laurie, I think that your client base is probably going to bear the bulk of this.
Laurie?
You know what? My client base either bears the bulk of the cost of the modification, or they bear the bulk of the cost of eventual foreclosure, which is going to be a much higher number. We've never said that the banks or the government should bear the cost. Clearly, the owners of the securities should bear the costs, and there have to be, what you want to do is keep those costs in check. And I think, a principal modification program is one way to help keep those costs in check.
Hey, Laurie, how do you think? Real quick question though, that the servicers are not incentivized to really modify. Do you think that there needs to be better incentives to put it to servicers to modify rather than foreclose?
I actually think servicers, I don't think there's a clear benefit for a servicer to foreclose rather than to modify. I think the incentives are pretty strong to modify. I've seen some numbers, and they do indicate the incentives are pretty strong to modify.
Mark,
why do you think that?
Go ahead, Paul.
No, then why do you think they're not modifying? Why do you think they're going down that foreclosure path? Just because it's just a machine?
I think they are modifying huge numbers of loans, and then a lot of these loans are redefaulting because these modifications aren't effective.
And they're not effective because they're writing down principal.
They're not effective because you're not re-equifying the borrower or coming close to re-equifying the borrower. And by the way, you don't have to write the guy down to 100. Writing him down to 120 would go a very, very long way. Everybody overestimates the value of their house to begin with, just like, all our kids are above average as well. But, and there are frictions to moving, so you don't have to write the guy all the way down to 100.
We have a very interesting comment. Paul, do you want me to go ahead and say that, or do you want to comment back? Sorry.
No, go ahead.
This comes from someone who works at one of the top 4 banks. Banks did principal reduction because A, they control policy over their loans, B, they use TARP funds, and C, it was used in combination with other solutions. Banks have stepped up. Now we need investors to step up like GSEs. Anybody want to take that on?
I won't say but I think that it definitely plays into a lot of what Laurie said. Clearly, some portion of the modification being a principal forgiveness is going to create the right kind of incentive or willingness to pay on the part of the borrowers. And so the more principal forgiveness that is a component of all the levers that you can pull in a mod will create the better incentives. And to Laurie's point, we don't have to do everybody back to 100. We just need to remove the significant amounts, and actually creating those frictions and reducing the moral hazard risk by sort of sharing the pain actually spreads the burden of the cost. And it's clear that if we don't do those things, that the do-nothing approach is going to ultimately cost us even more. So, it's applying all these different things and really being inventive with how we do it. And it's absolutely true that having the flexibility to create these kinds of more incentive or willingness types of modifications will make those programs more successful.
In terms of one comment on the GSEs, and that is the GSE problem is actually very, very complex. Because when if the GSE writes down as a principal reduction, and that loan doesn't redefault because they've done the principal reduction, they alone bear the cost. If they don't do the principal reduction and the loan ultimately defaults, oftentimes that cost is shared with the mortgage insurers. In addition, if the loan doesn't redefault, there's obviously, because they've done the principal reduction, then they also lose the value of the rep and warrant put back to the originators. So the problem is that, when the principal reduction is done from the GSE portfolio, they alone bear the cost, but the benefit is actually spread among them, the mortgage insurers, and the originators, and there's no way to cross that out properly. In addition, the GSEs are obviously a conservatorship. In a conservatorship, you conserve assets. It's very clear that principal reductions are NPV positive for the loan. It's not clear they're NPV positive for Freddie and Fannie, given that they alone bear the cost and the benefits are shared between them, the mortgage insurers, and the originators. So I think the GSE problem is actually a very, very, very complex one.
There's another question. We didn't talk about the interplay of first and second liens when it comes to principal reduction. Can we address that quickly?
Absolutely. I think, when you have a second, basically I think one of the reasons why you see principal reductions being far more common on the bank portfolios is the banks own the first, they own the second. They're looking to maximize the net present value of that loan. When you're in a private label security, the private label security is in the hands of an investor, the bank owns the second. And I think, that creates an inherent conflict of interest.
Thanks for that, Laurie. I really do need to wrap up, and I just wanted to go over the fact that, Laurie, you mentioned 11 million foreclosures ostensibly by 2012?
No. It's going to be, we've got borrowers who are currently paying, and that number is going to be much, much longer time frame than that. That's kind of an eventual, think of it as a sort of next 5-year type number.
Next 5 years. I thought that it was interesting that in the Treasury white paper it mentioned 8 to 12 million by 2012. And that was one of the figures that prompted me to want to focus on this particular topic today. But we've
I think their number also included, some of the foreclosures that have already occurred, and neither Mark nor I knowing it.
That's the clear distinction is Laurie's saying eventually all in total from now forward, it's another 11 million over 5 years. Mine is more that this is what we believe is currently in there today, and then others are saying, well, this is what's happened and what will happen. So you can get a wide variation of, the total stock over time versus the snapshot type of a scenario that we did.
Did you guys have any final wrap-up comments, Paul? Paul, are you still with us? Okay, Laurie?
No, I think we pretty well covered everything. Thank you very much for organizing this.
Thank you. Mark, did you have any final comments?
Oh, I agree with Laurie. I think this has been useful. I hope it's been useful for the people attending. I've looked at a number of the questions are really good there. And thank you very much for organizing this.
Thanks. Okay, so we'll go ahead and wrap up. On behalf of AmeriCatalyst, I'd like to thank our audience for being here today. As always, Laurie, Mark, and Paul, it's just an honor to be able to work with you guys and participate in this type of dialogue. Would like to thank Shirley Jackson on the production end, our underwriters, Field Asset Services, and CoreLogic. I hope that you all can join us here in Austin, November 6th through the 8th this year for the 10-year anniversary. And as a final reminder, many of you, this always cracks me up at our event, we always get better comments than questions because everybody's so sophisticated in our audience. So we will take those comments as well as questions, try to get the speakers to actually answer those questions that we did not address, and then we'll show some of the great comments that you guys have made, and we'll make that available by Friday, where you can also download this webinar and view it again, as well as recommended reading materials. Thank you once again. We really